Imagine for a second running this highly profitable nationwide business. I mean, you're generating over $17 billion dollars a year in revenue.
Which is massive scale.
Oh, it's huge. Your earnings are growing. On paper, you look like an absolute titan of industry. And here's the catch underneath that really shiny financial exterior. A single tragic failure, like a mistake made by a night shift worker at 3 in the morning.
Yeah.
That one mistake could trigger a $500 million lawsuit that just, you know, wipes out a massive chunk of your cash flow overnight.
And that's not a hypothetical, that's the reality.
Right. So today, we are opening up a buy-side investment memo on Universal Health Services operating under the ticker symbol UHS. And just for context, as we sit here in March of 2026, the company boasts a market capitalization of just under $12 billion.
Which, puts them squarely in the large cap healthcare space.
Exactly. And if you are sitting at home right now, right, and you're running a standard stock screener, UHS is going to scream BUI at you in these bright green letters.
Oh, absolutely. The algorithms love it.
Right. The algorithm sees a stock trading at roughly $193 a share, sitting at an estimated fair value of $212.
Which represents roughly a 9% discount.
Yeah, 9% discount.
Yeah.
But buying a stock purely based on a slight algorithmic discount to fair value, I mean, it's a lot like buying a house on a known seismic fault line, just because the seller threw in, like, free stainless steel appliances.
That's a great analogy.
You get so distracted by the shiny surface, right, by the immediate perceived bargain, that you completely forget to look down at the foundation. You have to look at the structural integrity, because when the ground shakes, those free appliances, they aren't going to save the house.
No, they are not. And that structural perspective, I mean, that is the perfect foundation for what we are doing today. Because when we evaluate a massive healthcare operator like this, the foundation is exactly where the hidden fractures tend to propagate.
Right, they're buried deep.
Exactly. Those fractures exist long, long before they ever show up in the headline earnings per share. I mean, in the institutional investing world, when you encounter a company with this specific profile.
A seemingly cheap valuation, right?
Yeah, a cheap valuation coupled with incredibly complex regulatory exposure. You cannot just, project historical revenue growth into the future, slap a multiple on it, and call it a day.
It doesn't work like that.
It really doesn't. You have to approach it with a completely different mindset.
Which is why our entire mission today for this deep dive is to evaluate whether UHS is actually a viable place to park capital using a very specific, I'd say, ruthless framework.
The skeptical buy-side lens.
The skeptical buy-side lens. And for anyone unfamiliar with that jargon, it essentially means our default stance for this entire deep dive is that this stock is completely uninvestable.
Unless it can mathematically and logically prove otherwise?
Right. We are not looking for reasons to buy. We are actively hunting for disconfirming evidence. We want to know how durable this company is when it's subjected to severe compounding stress.
And applying that skeptical framework is absolutely essential here because, frankly, this company sits at the intersection of three massive structural pillars of risk.
Okay, lay them out for us.
First, we have to navigate reimbursement volatility. I mean, this is the constant, never-ending political and regulatory tug-of-war over who actually pays for medical care.
And when that cash actually arrives, right?
Exactly. Second, there is the relentless pressure of labor inflation, particularly the structural shortage of specialized nursing staff, which we'll get into.
That's a huge issue everywhere. And the third?
The third, and perhaps most critically unique to Universal Health Services, is the behavioral health-driven legal tail risk.
Right. And I want to tackle that financial facade right out of the gate, because when you look at the surface pitch, the numbers management is super eager to highlight the financial headlines for UHS look genuinely fantastic.
They do. They really do.
Yeah. If their executive team walked into a conference room right now and just read off their fiscal year 2025 income statement, I mean, most casual investors would pull out their checkbooks on the spot.
I wouldn't blame them.
We're looking at fiscal 2025 net revenues of $17.365 billion. That represents top-line growth of almost 10% year over year.
That's robust for a company this size.
It is. And their adjusted earnings per share came in at $21.74. And their adjusted EBITDA, basically their operating cash profit before the accountants get involved.
Right, the raw operating metric.
Yeah, that was nearly $2.59 billion, up significantly from the year prior. I mean, on a spreadsheet, that looks like a legacy company firing on all cylinders.
Those growth numbers are undeniably strong on the surface. I mean, delivering a 10% top-line expansion for a mature $11 billion healthcare operator, that indicates they are successfully capturing patient volume.
And pushing through pricing increases to commercial insurers.
Exactly. The accrual accounting narrative, meaning the revenue they legally claim to have earned during the year, it paints a picture of a really thriving enterprise.
But, and this is a huge but, I was tearing my hair out looking at the actual cash flow statement provided in these sources because there is a massive, glaring divergence.
Yeah, the cash flow tells a very different story.
It completely does. While those earnings in that beautiful $21 EPS rose incredibly strongly, the actual operating cash flow went backward.
Which is always a huge red flag.
In fiscal 2024, they generated roughly $2.06 billion in operating cash flow. In fiscal 2025, despite the higher revenues and higher reported earnings, the operating cash flow fell to $1.86 billion.
And it gets worse when you look at free cash flow.
Right. If you look at a proxy for free cash flow, which, is the ultimate lifeblood of a business, meaning you take that operating cash flow and subtract the capital expenditures needed to keep the hospitals running.
The maintenance capex.
Yeah. It dropped from about $1.12 billion down to just $850 million. I mean, it's like running a catering business that boasts to the public about booking record-breaking million-dollar weddings.
Oh, I like this.
Right. But behind closed doors, the caterer hasn't actually collected the deposits from the clients yet.
That is exactly what's happening. That divergence between accrual accounting and cash accounting, it's the very first major red flag our skeptical framework identifies.
So what's driving it? Where is the money?
The core mechanism behind that divergence comes down to working capital and the timing of receivables. Specifically, a massive chunk of this missing cash is tied to Medicaid supplemental payments.
Okay, unpack that. Because Medicaid is notoriously complicated.
Extremely. In the hospital industry, the accounting rules allow you to treat the patient, record the revenue, and book the profit based on what you mathematically expect to be paid by insurers and government programs.
Right. You book the profit the moment the service is rendered, assuming the check is in the mail.
Exactly. But actually getting the government to physically cut that check, especially for these incredibly complex multi-state supplemental reimbursement programs, it can take months.
Or longer.
Yeah, sometimes the payment cycle slips entirely into a different fiscal year. So Universal Health Services saw their receivables swell. The cash is essentially trapped on the balance sheet as a giant IOU from state and federal governments.
Now, I have to assume that waiting on government IOUs, while deeply frustrating for a CFO, it isn't necessarily fraudulent, right?
No, fraudulent. It's perfectly legal accounting.
But it completely changes the quality and the reliability of the earnings we are analyzing. I mean, if I'm an investor building a valuation model, $1 of cold, hard cash sitting in a corporate bank account today is worth significantly more than $1 of government receivables.
Infinitely more. Because that receivable might require an audit, a political debate, or a budget resolution before it ever gets paid out.
Right. It forces a disciplined investor to raise the bar for their valuation comfort.
It fundamentally reduces your confidence in the company's single-year cash conversion cycle. I mean, you might have pristine earnings per share, but your cash conversion is degrading.
And what happens if the economy turns?
Well, if the broader macroeconomic environment hits a recession and states suddenly face budget shortfalls, those supplemental payment programs are often the very first line items to get scrutinized, delayed, or restructured.
That is terrifying for a business model.
Yeah.
But as troubling as that cash flow timing is, the sources make it clear that the working capital drain is really just the appetizer when it comes to the skeptical reality.
The main course is much heavier.
Yeah, the main course is what the analysts refer to as the fat tail legal risk.
Mm.
And the numbers attached to this risk are absolutely staggering.
Truly staggering.
Universal Health Services had to disclose a $535 million jury verdict against an indirect behavioral health subsidiary.
A single verdict. $500 million.
Yeah. This was regarding a minor-on-minor sexual assault case at one of their facilities. Management had to explicitly warn shareholders that the ultimate outcome of this case could be materially adverse, even after factoring in their insurance coverage.
And that wasn't the only one.
No. On top of that, there's a separate legal matter in Nevada where a jury awarded $500 million in punitive damages against another UHS subsidiary.
Though, we should provide the full context on that Nevada case.
Fair point.
The company stated that state statutory caps will likely reduce that massive punitive damage figure down to roughly $14 million, and the entire matter is still subject to the appeals process.
I understand the actual cash payout at the end of a long appeals process might be a fraction of the headline number. But I really want to linger on this statistical concept of fat tails, because these are not your normal run-of-the-mill slip-and-fall corporate lawsuits.
Not at all.
We are talking about multiple $500 million jury verdicts targeting their core operations.
Understanding the mathematics of fat tails is really the key to understanding the behavioral healthcare investment thesis entirely.
On through it.
Sure. So in traditional statistics, a normal distribution is your standard bell curve. Most outcomes, most operational costs, they cluster predictably around the middle.
Right.
The tails of that curve, representing extreme catastrophic events, are very thin, meaning they're highly improbable. A standard business model assumes those events basically never happen.
But a fat tail distribution.
A fat tail distribution means that extreme catastrophic outlier events have a much higher probability of occurring than a standard model would ever predict.
And a $500 million jury verdict over patient safety is the textbook definition of an extreme outlier.
It absolutely is. What the skeptical framework insists upon is recognizing that legal risk for a company operating psychiatric facilities is not just a series of routine one-off legal charges that you can smoothly amortize over a decade.
Not a parking ticket.
Exactly. A single severe incident, especially in a locked-door setting with a highly vulnerable patient population, it triggers an immediate cascade of financial consequences. The payout of the verdict is almost the least of your worries.
Wait, really? The $500 million payout is the least of their worries.
Well,
Walk me through that cascade. How does a single verdict metastasize into a broader financial crisis for the company?
it starts with insurance repricing. A hospital network like this utilizes self-insured retentions.
Which means what, exactly?
It means the corporation acts as its own insurance company for the first 10, 20, or even $50 million of any claim, paying that straight out of their own operating cash flow before the commercial umbrella policy kicks in.
Oh, wow, okay.
So if your commercial insurer has to pay out on a massive claim above that retention limit, your premiums for the entire nationwide corporation are going to skyrocket the following year. Or the insurer will simply demand a much higher self-insured retention limit going forward.
Which means the company is on the hook for even more cash out of pocket the next time something goes wrong.
Precisely. Furthermore, you face immediate licensing reviews and admission freezes from state health departments.
Which halts revenue at the affected facility entirely.
Yep. Then you have the reputational damage. I mean, think about it. If you are a top-tier psychiatric nurse or a highly sought-after physician, you are going to think twice before taking a job at a facility constantly in the local news for catastrophic safety failures.
Right, nobody wants their name attached to that.
So recruiting costs spike, reliance on expensive temporary agency labor increases, and the margins compress further.
So the normal operational variance that analysts usually obsess over, like tracking a 50 basis point fluctuation in hourly wage costs, that gets completely overwhelmed by these massive discontinuous shocks.
Completely overwhelmed.
You aren't just losing a lawsuit, you are fundamentally altering the cost structure of the business for years.
This is why you cannot model a fat tail risk by just casually trimming your profit margin assumption by 1 or 2% in a spreadsheet.
Right.
You have to step back and ask if the entire valuation framework makes sense when a single unpredictable courtroom decision can wipe out a quarter of your annual free cash flow.
Man, knowing all this, knowing that the company is constantly navigating massive, complex legal threats, dealing with opaque, multi-state government reimbursement delays, and managing tens of thousands of employees in high-stress environments. It makes me think about the people steering the ship.
Management is everything here.
It has to be. This level of complexity requires an incredibly agile, responsive management team. So if a facility is failing or a reimbursement program is restructured, is UHS actually set up to pivot quickly?
That is the million-dollar question.
And more importantly, if the ship is heading toward an iceberg, who is holding the steering wheel, and can the shareholders take it from them?
To answer that, we have to examine the corporate governance structure, which is deeply, deeply entrenched. This is a crucial element of the disconfirming evidence against the stock.
Because When you look at the ownership structure of universal health services, you are not looking at a standard, modern, responsive, publicly traded corporation.
No, you are not.
You are essentially looking at a family dynasty that happens to be listed on a stock exchange.
Yeah.
UHS was founded way back in 1979 by Alan B. Miller. Fast forward to today, March 2026, and Alan B. Miller is still sitting as the executive chair of the board. His son, Mark D. Miller, is the CEO and president.
And the absolute kicker is the voting power.
Yeah, tell him of the voting power.
Through a system of multi-class shares, the founder family controls roughly 88% of the voting power.
88%.
88%. That dual-class share structure fundamentally alters the relationship between the company's management and the public markets.
Right.
We see this often in technology companies, where a founder retains voting control to protect a long-term product vision from short-term Wall Street pressure. But applying that structure to a highly capital-intensive, heavily regulated healthcare provider, it creates a very different dynamic.
I want to frame this directly for you listening right now. If you buy shares in UHS today, and you're a minority shareholder, and things suddenly go south, say the behavioral health legal liabilities become unmanageable, what power do you actually have to enact change?
Operationally and strategically.
You have absolutely zero power. You cannot launch an activist investor campaign. You cannot vote to replace the board of directors. You cannot force a sale of the company to a private equity firm to unlock the value of the real estate. You are entirely a passenger in a car driven by the Miller family.
To maintain objectivity, though, the sources do note that this family-controlled structure is a double-edged sword. It's not automatically a villainous or incompetent setup.
Fair. What's the upside?
Family control, especially sustained across multiple decades, allows a company to maintain a very long-term orientation. They don't have to obsess over a single bad quarterly earnings miss the way a typical hired gun corporate CEO might.
Right.
They can invest in 5-year growth projects like building brand new hospitals from scratch without fearing a proxy battle from an impatient hedge fund. That continuity sustains corporate culture and execution. And clearly, over the past 40 years, they have successfully built a massive, scaled operator from the ground up.
I acknowledge the benefit of ignoring short-term noise. But the other edge of that sword is incredibly sharp when the macro environment or the regulatory landscape fundamentally changes.
Because continuity can very easily morph into complacency.
Exactly. It embeds structural blind spots. When the exact same leadership team, tied by blood, has been running the exact same operational playbook for decades, there can be a profound psychological reluctance to admit that the old way of doing things is now generating unacceptable levels of legal and regulatory exposure.
Especially around things like clinical safety protocols, mandated staffing ratios, and internal audit controls in those behavioral health settings.
Let's look at the timeline of their recent strategic inflection points, because it paints a very specific picture of where management's attention is being forced.
Yeah, the timeline is revealing.
In 2020, UHS agreed to a $117 million settlement with the Department of Justice over False Claims Act allegations.
Right.
Break down the False Claims Act for me. What exactly was the government accusing them of doing?
So the False Claims Act is the federal government's primary litigation tool for combating fraud against government programs like Medicare and Medicaid.
Okay.
In this specific 2020 settlement, the government alleged that UHS was providing medically unnecessary inpatient behavioral services, keeping patients longer than clinically dictated to maximize billing, and failing to provide adequate legally mandated care.
That is heavy stuff.
It is. To settle the claims, UHS paid the $117 million and, crucially, was required to enter into a corporate integrity agreement with the government.
Which means they didn't just write a check and walk away. A corporate integrity agreement means intense, ongoing compliance monitoring. They essentially have federal auditors looking over their shoulders.
Yes, it is a multi-year mandate that fundamentally alters how internal compliance is handled, requiring independent review organizations to audit their claims.
Okay, so that's 2020.
Then we move forward to 2024, and we see the disclosure of that massive $535 million jury verdict regarding facility safety we discussed earlier.
Right.
Then in 2025, we see their financial results being heavily propped up by the recognition of those complex, state-directed Medicaid payments.
When you lay out those inflection points, the 2020 DOJ settlement, the 2024 $500 million safety verdict, the 2025 reliance on opaque Medicaid funding, a very clear pattern emerges.
What do you see?
None of those critical moments are about a revolutionary new medical technology. None of them are about a brilliant new operational efficiency that expands their profit margins organically.
No, they aren't. The critical moments shaping the company's current trajectory are increasingly about managing their non-operational surface area.
Exactly.
Their bandwidth is continually absorbed by legal defense, Department of Justice settlements, navigating corporate integrity agreements, and complex Medicaid lobbying. When a management team's primary challenges shift from purely operational execution to legal and regulatory survival, a skeptical investor has to view that as a glaring warning sign regarding the sustainability of the business model.
The sources actually provide a really fascinating management scorecard that synthesizes this. It's not an emotional critique, it's a structured evaluation of how leadership handles capital allocation and risk.
How did they score?
On strategic vision, they score a very respectable 4 out of 5. They have a clear, consistent focus on their specific healthcare niches, and they are incredibly disciplined with their Wall Street guidance.
Okay, that aligns with their history.
Overall management and operational execution both score a 3 out of 5.
Yeah.
The earnings growth is real, and the hospital occupancy levels remain stable. But the governance score drops to a dismal 2 out of 5.
Ouch.
And that low score directly ties back to the 88% voting control.
Because when a crisis hits, capital allocation might prioritize family legacy over minority risk-adjusted returns. Let's run a hypothetical scenario.
Let's do it.
Imagine a purely rational, independent board of directors looks at the behavioral health segment today. They see the DOJ settlements, they see the fat-tail jury verdicts, and they decide the legal risks have just become too toxic.
Right.
The most rational move for shareholders might be to spin that behavioral division off into a separate company, or sell it entirely and focus solely on the safer acute care hospitals.
But a family-controlled board, deeply tied to the historical legacy of having built that behavioral empire over 40 years, might outright refuse to sell it out of sheer pride or a desire to maintain the sheer scale of the empire their father built.
Exactly. And as an investor, that structural reality demands a severe discount factor. You are taking on the entirety of the financial risk without holding the associated governance rights to mitigate it.
And to really understand why UHS faces so much of this specific legal and regulatory scrutiny in the first place, we have to look under the hood at the exact services they provide and the specific patient populations they serve.
It's a completely hybrid business model, which is incredibly rare at this massive scale.
Right, most major hospital operators choose a lane and specialize.
They do.
If we break down the revenue mix, it's a 57-43 split. About 57% of their revenue comes from traditional acute care and outpatient services. The other 43% comes from behavioral health.
And what stands out is that this mix has been incredibly stable. If you go back to 2021, the split was basically identical.
They aren't quietly pivoting away from the risky behavioral side or doubling down on acute care. They are deeply committed to maintaining this hybrid engine.
And that stability means, as analysts, we have to evaluate two completely different sets of unit economics coexisting under one corporate roof.
I look at it like this. It's like a hospitality company running a standard high-volume hotel on one side of the street and a highly specialized locked-door wellness retreat on the other side.
That's a vivid way to put it.
They are both technically in the business of filling beds, but the daily operations, the risks, and the economics could not be more different. Let's look at the acute care side first.
Sure.
For the first 9 months of 2025, the average length of stay in their acute care hospitals was 4.8 days. The occupancy rate was 67%. Patient admissions were up slightly.
That acute care side represents your standard hotel in this analogy. A patient comes in for an appendectomy, a scheduled joint replacement, or a cardiac procedure. They stay for just under 5 days, they recover, and they are discharged.
Throughput is the name of the game.
You want high turnover, specialized procedure billing, and incredibly efficient use of the surgical suites. It's a highly operational, logistics-driven business.
But then you cross the street to the behavioral health side. The operational metrics completely flip.
They really do.
The average length of stay jumps to 13.6 days, almost 3 times as long as acute care. And the occupancy rate is much higher, sitting at 74%.
And from a purely spreadsheet-driven economic perspective, those behavioral metrics look incredibly attractive to an investor.
Because the bed is filled for 2 straight weeks, generating daily revenue instead of flipping every few days and sitting empty while housekeeping cleans it.
Exactly. Furthermore, higher occupancy and longer lengths of stay generally mean more stable, predictable, daily revenue. You also have fewer administrative costs associated with the constant friction of admitting and discharging patients. It's a steady, highly utilized asset profile.
This is where the skeptical framework demands the arch. We look at the hidden cost of that financial stability. You mentioned earlier how the very features that make behavioral health economically attractive are the exact same features that create the massive legal exposures.
It's the core tension of the whole business.
It feels like the central paradox of the entire UHS investment thesis.
It absolutely is the central paradox.
Yeah.
A 13-day average length of stay means you have a patient residing in your facility 24 hours a day, often involuntarily committed or under severe psychological distress.
Right.
These are highly vulnerable populations dealing with acute psychiatric crises, severe substance abuse withdrawals, or profound trauma. The legal and moral duty of care required in that environment is immense.
It's life or death.
If your staffing ratios drop because of a localized labor shortage, or if an overworked night shift nurse misses a legally required 15-minute bed check, the outcome isn't just a delayed meal delivery or a frustrated patient complaining to management. The outcome can be a tragic, catastrophic event: self-harm, patient-on-patient assault, or severe medical neglect.
The long stays and high occupancy create a literal pressure cooker environment. The severity of an adverse event is magnified exponentially compared to a standard hospital ward. And that underlying operational reality leads directly to the headline risk and the fat-tail half-billion-dollar jury verdicts we discussed. You were essentially generating high-margin revenue by taking on an unquantifiable amount of left-tail human risk.
This distinct risk profile is exactly why the market struggles to benchmark UHS against its peers.
Let's talk about the peers.
If you look at the broader healthcare landscape, HCA Healthcare is the massive gold standard benchmark in the acute space. They have over $75 billion in revenue, and they do not touch behavioral health at the scale.
Okay, so that's the pure acute play.
Then you have Acadia Healthcare, which is a pure-play behavioral operator with about $3.3 billion in revenue, and predictably, they are facing their own significant legal and operational challenges inherent to the space.
Tenet.
Tenet Healthcare sits primarily in the acute and ambulatory surgery space. Universal Health Services is uniquely stuck right in the middle.
They have the revenue diversification of acute care, which provides a helpful floor for cash flow, but it doesn't insulate them from the behavioral tail risk dragging down the entire enterprise.
No, it doesn't.
The market looks at the whole entity and struggles to assign a clean valuation multiple because the behavioral side acts like a constant, unpredictable overhang.
Adding another layer of complexity to their valuation is the revenue quality we touched on earlier.
The Medicaid stuff.
Right. The data shows that revenue per unit is rising faster than actual patient volume. Acute per-day revenue was up 7%, and behavioral was up 7.2%.
On paper, to a passive observer, that looks like incredible pricing power. It looks like they have the leverage to demand higher rates from commercial insurance companies. But I have to push back on that narrative based on what we see in the cash flows. Is this real, organic, sustainable growth driven by market dominance? Or is this just an accounting mirage driven by opaque government subsidies?
The sources highlight this specifically as the supplemental payment illusion. It is heavily dependent on state-level Medicaid mechanics.
Let's get into the mechanics.
In 2025, UHS disclosed a $90 million net reimbursement from a single Washington, D.C. Medicaid program. And historically, they have recognized massive financial benefits from multi-state provider tax and uncompensated care programs.
Massive.
In 2022, that benefit was almost $500 million, $497 million to be exact.
Okay, we need to break down the actual mechanism of this Medicaid shell game. How does a hospital magically generate $500 million in supplemental revenue without treating $500 million worth of new patients?
To understand why this is an illusion, or at least a highly fragile foundation for a long-term investment, you have to understand the flow of funds.
Follow the money.
Always. These are not standard fee-for-service contracts where a doctor bills for an MRI and the government simply pays the invoice. These are highly complex, politically engineered funding mechanisms.
Okay, so how does it flow?
Often it works like this. A coalition of hospitals pays a specialized provider tax directly to the state government.
Wait, the hospitals pay the state?
Yes. The state then takes that pool of tax money and uses to demonstrate funding capacity to Washington, D.C., which allows the state to draw down matching federal Medicaid funds.
Oh, I see where this is going.
The state then takes that newly expanded federally matched pool of money and redistributes it back to the hospitals in the form of supplemental payments.
So the hospital is literally writing a tax check to the state just so the state can trigger a federal multiplier, and then the state sends a larger check back to the hospital.
That is the exact mechanism.
It is a localized fiscal stimulus using the hospital as a conduit.
Yes. It is a vital lifeline designed to keep safety net hospitals afloat in low-income areas. But from a purely analytical investment standpoint, this is a political instrument, not durable, organic business revenue.
Because it can disappear.
Exactly. Treating it like organic pricing power when projecting future earnings is deeply dangerous. These programs require constant federal and state legislative approvals. They can be delayed by political gridlock in the state legislature.
Or audited.
Or audited by the Centers for Medicare and Medicaid Services and clawed back retroactively if the matching formulas are deemed improper.
Which perfectly explains the cash flow divergence we analyzed at the very beginning of this deep dive. You booked the $90 million from the DC program as revenue today, so your EPS looks pristine, but the actual cash from that complex federal-state matching process might not arrive in your bank account for another 9 to 12 months.
And that creates a surprise working capital drain.
Precisely. Your earnings look beautiful, but your cash conversion quality is degrading behind the scenes. And critically, if the broader economy hits a recession and states face severe budget shortfalls requiring austerity measures, those complex supplemental programs are often the first things to get scrutinized, delayed, or legally challenged.
It's a very fragile setup.
So if the revenue quality is murky and heavily dependent on political wins, and the behavioral segment carries $500 million fat tail legal risks, and the family-controlled governance structure means minority shareholders have no voice.
That's quite the list.
Right. The absolute next logical question for any investor has to be about solvency. Can universal health services survive a worst-case scenario? We need to transition into their financial quality and run a real, punishing stress test.
This is where the analysis has to separate the surface-level debt metrics from the dynamic reality of how a healthcare system actually functions under pressure.
Let's start with the surface level. On the surface, the leverage looks almost boringly safe. Total debt is about $4.75 billion, sitting against $7.7 billion in equity.
That's a strong equity cushion.
Their debt-to-adjusted EBITDA ratio is roughly 1.83 times. That is actually an improvement from 2.01 times back in 2024. In the universe of corporate finance, especially for a capital-intensive hospital operator, 1.8 times leverage is a genuine strength.
Nobody is sweating a debt crisis or an imminent default at those levels under normal sunny day conditions.
And their liquidity position robustly backs that up. They recently amended their credit facilities, securing a $1.3 billion revolving credit line and a $1.2 billion term loan.
And as of late 2025, they still had about $965 million available to draw on that revolver.
So they have access to cash if they need it.
Yes, plenty of liquidity.
They also proactively manage their debt maturities. They recently refinanced a looming 2026 debt cliff, issuing new notes that aren't due until 2029 and 2034.
Yeah.
But there is a massive hidden cost there.
There always is.
They were rolling off old pandemic-era debt that carried a tiny 1.65% interest coupon and replacing it with new notes carrying interest rates around 5% or higher.
That is a classic symptom of the current macroeconomic environment. The imminent maturity cliff is gone, which is great for short-term survival, but the structural interest cost to the business has permanently stepped up.
It's a huge jump.
Going from 1.6% to 5% on billions of dollars of debt means your annual interest expense skyrockets. Every single dollar of free cash flow now has to jump over a much higher interest hurdle before it ever reaches the equity holders.
So we have established that the balance sheet is fundamentally sound in a vacuum. But we aren't investing in a vacuum.
No, we are not.
Let's design the skeptical stress test. Because a good investor shouldn't just ask if a company can pay its bills on a sunny day. The framing question must be, what happens when it rains, hails, and floods, all at the exact same time?
That brings us to the triple threat scenario outlined in the sources. In complex systems like healthcare, we aren't looking for a single point of failure. We are looking for converging, compounding shocks that feed off each other.
Let's build it out sequentially. Shock number 1. The policy and working capital shock. Let's say the macroeconomy softens. Unemployment ticks up even a couple of percentage points, which means the uninsured rate rises because people lose their employer-sponsored commercial coverage.
Makes sense.
At the exact same time, state budgets tighten due to lower tax revenues, and those massive, complex Medicaid supplemental payments get delayed in political gridlock.
Yeah.
Suddenly, bad debt spikes because patients physically can't pay their out-of-pocket bills, and the accounts receivable balloon because the government is sitting on the matching checks. So your top-line cash generation stalls out.
Right. Your cash inflows are suddenly restricted. Now layer on shock number 2, the labor shock.
Oh boy, the labor shock.
Wage inflation reaccelerates. The structural nursing shortage bites hard, forcing hospital administrators to rely heavily on expensive temporary travel agency nurses just to keep the psychiatric wards open and meet state-mandated staffing ratios.
Which absolutely crushes margins.
Historically, we have seen severe labor shocks compress hospital EBITDA margins by 150 to 250 basis points almost overnight.
So now the cash coming in is delayed, and the cash going out to pay premium hourly wages has skyrocketed. The system is incredibly fragile. Now the floodwaters arrive. Shock number 3, the legal shock.
The fat tail event.
Due to the high turnover of temporary agency staff, a catastrophic safety failure occurs in a behavioral facility. Another massive jury verdict drops. But this time, because of previous claims history, their insurance deductibles and self-insured retentions are much higher.
The safety net has holes in it.
The corporation is forced to fund $50 million of cash out of pocket immediately just to satisfy settlements or post bonds for the appeals process.
This specific convergence is where that seemingly safe 1.8 times leverage ratio completely stops being a comfort blanket.
Because the denominator of that ratio, the EBITDA, is collapsing due to the labor costs, while the numerator, the debt, is rising rapidly as they draw down the revolver to cover the cash burn and the legal settlements.
Precisely. What you are describing is the mechanics of probabilistic covenant pressure. Their credit agreements with the banks likely have a maximum net leverage ratio covenant, historically set around 3.75 times.
Right, a legal limit.
In a triple threat scenario, you don't breach that bank covenant because you recklessly borrowed too much money to build a new hospital wing. You breach it because your trailing earnings evaporate at the exact same moment your working capital and legal cash needs explode.
And once you approach that covenant limit, the constraint isn't just a mathematical formula on a bank document.
No, the real constraint becomes sheer cash availability and cascading reputational damage. If you are actively drawing down your final revolver capacity to pay legal settlements while your operating margins are compressing, state regulators take notice.
And the sharks start circling.
Commercial payers, the big insurance companies, smell weakness and start playing hardball on contract negotiations, demanding lower reimbursement rates. You lose negotiating leverage with every single stakeholder in your ecosystem simultaneously.
Man. So we have clearly established that while the balance sheet is currently a fortress, it is a fortress built in a very dangerous, seismically active neighborhood. Which forces us to ask the ultimate investor question. What does this all mean for the actual stock price?
Valuation is where the rubber meets the road.
If we can sit here and clearly identify these compounding risks, the institutional market can certainly see them too. Are all these doomsday scenarios already fully baked into the current $193 valuation? Or is the market still stubbornly optimistic?
This takes us directly into the valuation scenarios and the vital concept of the discount rate stock.
Let's look at the multiples. Right now, UHS is trading at a low to mid single-digit EV to EBITDA multiple. To put that in plain English for anyone running a screener, investors are paying a very small premium relative to the cash profits the business generates.
Very small.
If you compare that multiple to a massive consumer tech company or even a pure-play acute operator like HCA, it looks dirt cheap.
And that optically low multiple is exactly what triggers the classic value investor's instinct. It looks like a textbook value play, a mispriced asset ripe for a rebound.
The sources ran a series of rigorous discounted cash flow, or DCF, models using fiscal 2025 scale and debt levels. And the spread of the mathematical outcomes is absolutely wild. Now, let me read these scenarios out because the mechanics matter.
Go for it.
In their base case, assuming revenues grow at a modest 5%, slowly cooling to 3% over time, with margins holding steady around 14.9% and a weighted average cost of capital. The discount rate applied to future cash flows at 9%. The fair value comes out to about $240 a share.
That implies a nice, comfortable chunk of upside from the current trading price.
That is a very solid, defensible base case assumption if the status quo holds. Then you have the bull case. In this scenario, growth stays higher at 6%, operational margins expand to 16% due to labor cooling, and the cost of capital drops slightly to 8.5%.
And what's the value there?
In that scenario, the stock is worth $385 a share. It's a multi-bagger. Everything goes right. No major lawsuits, Medicaid flows smoothly, inflation dies down.
But the value of a DCS isn't in the bull case. It is in understanding the sensitivity of the downside.
And that downside case is terrifying. Growth slows to a crawl at 2%. Margins compress to 13% due to agency labor costs. And crucially, the discount rate gets hiked up to 10% by investors demanding a higher return to stomach the risk.
It completely collapses.
The fair value in this scenario absolutely collapses to roughly $90 a share. We are talking about the stock getting cut in half from where it trades today.
The immense chasm between a $90 downside and a $385 upside is the defining characteristic of this investment. It is not a stable asset.
I have to ask the obvious question. If I'm an investor looking at a low single-digit multiple today, isn't that just a screaming bargain? Why not just buy it at 193, hold your nose through the headline volatility, and wait for the broader market to wake up and re-rate the multiple to match a giant like HCA?
Because you cannot assume that a low multiple is simply a temporary mistake made by an irrational market. In complex sectors like healthcare, a persistently low multiple is very often a market-imposed penalty.
The trust discount.
Exactly. It's what we call a trust discount. It is like trying to sell a used car that looks pristine on the lot, but the Carfax shows it has been in 3 unexplained accidents.
Right.
Buyers aren't going to pay the Kelley Blue Book value no matter how shiny the new paint job is. They are applying a trust discount because they fear what is hiding under the hood.
So the market is looking at the 88% family voting control. It is looking at the history of DOJ False Claims Act settlements. It is looking at the $500 million jury verdicts, and the collective market is effectively saying, we simply do not trust the durability of these earnings enough to pay a premium for them.
Which means UHS is the quintessential discount rate stock. The valuation swings wildly, not just based on how many hospital beds they fill this quarter, but on the discount rate, the required rate of return applied to their long-term cash flows.
So if the market gets spooked,
if institutional consensus decides that the severe legal tail risks in the behavioral segment require a 10% or 11% discount rate just to compensate for the danger of holding the equity, the mathematical gravity of that formula will relentlessly pull the fair value down toward that $90 downside case. You aren't just losing revenue in that scenario, you are facing severe multiple compression.
and here is the brutal reality for the management team. They cannot simply earn their way out of a trust discount with a couple of good quarterly earnings reports.
No, they can't.
You can beat Wall Street EPS estimates by 10 cents for 3 quarters in a row, but if a new lawsuit drops in quarter 4, the multiple stays compressed. To structurally re-rate the stock, they have to fundamentally prove to the market that the left tail risk the catastrophic legal and safety outcomes have been permanently shrunk.
The probability math provided in the sources is highly sobering.
I'll break down the probability.
If you assign realistic probabilities to these scenarios, let's say a 40% chance of the base case occurring, a 20% chance of the optimistic bull case, and a 40% chance of the devastating downside case, the expected probability-weighted value lands near $210 a share.
Which is only a tiny fraction above the $193 it trades at today.
Exactly.
Okay.
It tells you that the mathematical upside is real, but it is deeply symmetrical with the downside risk. You are absolutely not getting a massive margin of safety for taking on the distinct possibility of a $90 floor. You are risking 50% of your capital to make 10%.
Wow. So knowing the tightrope they're walking, we need to pivot to the final analysis. The real world. What exactly needs to happen out there in the operational economy and inside their hospital wards to make this stock a safe, compounding place to park capital?
We need to define the catalysts and the red flags.
Let's talk catalysts first, and then the final verdict. Let's define exactly what would move the needle for a skeptical investor. What tangible events could drive this stock up in the near term?
Well, management's guidance implies continued revenue and EBITDA expansion.
Right.
We know they are spending about $1 billion annually on capital expenditures. So obviously, if they open new de novo hospitals, meaning building brand new facilities from scratch rather than acquiring messy existing ones, and those new facilities ramp up to profitability quickly without suffering early year operating losses, that demonstrates excellent operational execution and is a huge win for the stock.
Another massive catalyst would be the demonstrable stabilization of their liability costs. If they can navigate through a couple of years without their commercial insurance premiums spiking, or without having to fund massive self-insured retentions straight out of their operating cash flow, the market might slowly start to relax that punitive discount rate.
Yes, that would be huge. And then there is the mechanism of capital return. They are continuing to buy back shares.
Let me play devil's advocate here for a second, because this is a really common value investing thesis.
Go ahead.
If the stock is trading at a depressed, low multiple, and management just uses their excess cash to relentlessly buy back their own stock, continuously reducing the outstanding share count, doesn't the per-share math eventually work out favorably for the remaining investors, regardless of the broader noise?
That strategy works mathematically if and only if the share buybacks are funded by true, durable free cash flow after all maintenance and growth capital expenditures have been met.
Right.
But if a company is buying back stock while simultaneously relying on delayed Medicaid working capital to keep the lights on, or worse, if they are masking underlying margin deterioration with debt-funded repurchases, it is a catastrophic trap.
A value trap.
A buyback executed at a low multiple is brilliant capital allocation unless the multiple is low because the underlying business is actually deteriorating, in which case management is just using shareholder cash to buy a larger slice of a rapidly shrinking pie.
Which brings us to the red flags that would signal the pie is indeed shrinking. And the primary red flag is simply the sheer continued existence of these repeated, high-profile legal matters.
They just keep happening.
Even if a Nevada judge steps in post-trial and caps a $500 million punitive damage award down to a manageable $14 million, the structural damage is already done the moment the verdict hits the wire.
Because the secondary, systemic effects are insidious. As we discussed, an ongoing litigation narrative creates immense reputational drag. If you are a top-tier psychiatric nurse with multiple job offers, do you want to work for the facility constantly in the local news for safety violations?
Definitely not.
If you are a commercial insurance provider, do you use the threat of these public lawsuits to ruthlessly negotiate lower reimbursement rates for the hospital network? The legal headlines erode your negotiating leverage everywhere.
And the ghost of that 2020 Department of Justice False Claims Act settlement still lingers over all of this analysis.
It absolutely does. The sources are careful to note that a past settlement does not legally prove present misconduct. We cannot assume they are doing anything improper with their billing today.
Of course.
But from a purely analytical investment perspective, that history structurally raises the burden of proof. When a company has a documented history of federal scrutiny regarding the adequacy of its clinical care and its billing practices, an intelligent investor demands a much higher margin of safety before assigning a premium valuation multiple to those specific earnings.
So, stripping away the noise, what is the actual path to investability? What does Universal Health Services need to fundamentally change to graduate from the too hard pile on an investor's desk?
The deep dive outlines 4 clear non-negotiable steps.
We're not coming through them.
First, they need to demonstrate a multi-year reduction in severe safety incidents. Not just corporate PR spin, but hard, verifiable claims trends and lower insurance premiums showing the behavioral facilities are genuinely getting safer.
Okay, that's number one. What's the second?
Second, they need to provide clear evidence that the supplemental Medicaid revenue is durable. They need to prove that these opaque state-level programs aren't just masking underlying weakness in their commercial payer mix as macroeconomic conditions shift.
Got it. Third.
Third is ironclad capital allocation discipline. Like you explained, any future share buybacks must be definitively funded by true free cash flow, not by playing working capital games with government receivables.
The fourth step.
And fourth, they need tangible governance improvements. We know the Miller family isn't going to voluntarily surrender their 88% voting control, but they could introduce stronger, genuinely independent board oversight. They could explicitly tie executive compensation bonuses not just to raw EBITDA growth, but to achieving strict safety and quality clinical KPIs.
So, bringing all of this complex analysis together, we need to deliver the final analytical verdict based on the skeptical framework. Is universal health services a great business or just a good business trapped in a bad structure?
Based on the entirety of the disconfirming evidence we have explored, UHS is undoubtedly a good business. They have built massive national scale, they provide absolutely essential medical services, and they have strong, undeniable baseline earnings power.
Yeah.
But the toxic combination of the behavioral health legal tail risks, the heavy reliance on politically mediated Medicaid cash flows, and the impenetrable 88% family control prevents it from ever being a truly great business. It fundamentally lacks the durable, low volatility economic profile that a great compound interest business possesses.
So for a conservative, long-duration capital allocator sitting here in March of 2026, looking at that $193 price tag on their screen,
It is definitively not investable. The downside distribution is simply too wide. When your ultimate equity value is so heavily path-dependent on unpredictable courtroom outcomes, jury moods, and state-level political budget negotiations, the margin of safety at a mere 9% algorithmic discount to fair value is an absolute mirage. You need a much wider discount to compensate for the fat tails.
wow, that is a definitively clear, uncompromising verdict. For everyone listening who's stuck with us through the accounting mechanics and the legal theories, let's distill this incredibly complex, multi-layered analysis down to the most vital takeaways. We started this deep dive looking at a stock that seemed like a screaming algorithmic bargain, and we peeled back the layers to find the fractured structural foundation.
The foundation was definitely cracked.
Takeaway number one, UHS's headline earnings growth is incredibly impressive, but it is masking underlying cash flow volatility. When working capital gets tied up in complex government receivables and state-directed tax programs, a dollar of reported EPS does not equal a dollar of cash in the corporate bank account.
Takeaway number two, the hybrid business model is a severe double-edged sword. The behavioral health segment offers incredibly attractive unit economics on paper, high occupancy, and long patient stays. But those exact same dynamics create a pressure cooker environment that breeds fat tail legal risks capable of compressing valuation multiples overnight.
And takeaway number three, governance dictates destiny. With the founder family controlling 88% of the voting power through dual-class shares, minority investors have virtually no recourse if management decides to double down on a risky strategy or prioritize legacy over returns. That entrenched structure inherently justifies a persistent trust discount on the stock.
If there's one overarching permanent lesson here for healthcare investing, it is that a low valuation multiple is rarely an invitation to buy. It is almost always a warning sign. The institutional market is highly efficient at pricing in governance and liability risks. Until those underlying safety and structural metrics demonstrably improve, the multiple is exactly where it belongs.
I want to leave you with a final thought to mull over as you review your own portfolio. We talked so much about institutional scale today, $12 billion market caps, tens of thousands of hospital beds, national presence, complex federal matching programs.
Massive, massive scale.
But if healthcare is inherently a deeply local, profoundly trust-based business where a single failure of care can destroy a community's confidence overnight, can a massive, family-controlled corporate entity ever adequately price the risk of losing that trust across a nationwide portfolio? That is the structural question you have to answer before buying a single share. Thank you so much for joining us on this deep dive.